I think we're ready to get started again. Welcome back. Our next panel is going to discuss one of the major issues in securities crowdfunding, which is response without overreach. How do we create that robust system of investor protection that is the hallmark of the American securities market without crushing what is a somewhat delicate industry because we're talking about very small businesses? Our moderator for this panel will be Vince Molinari. Mr. Molinari is the founder and chief executive officer of Gate Technologies, a broker-dealer focusing on using technology to close the gap between traditional and emerging alternative markets. Mr. Molinari began his career at Lehman Brothers and has also held senior positions at Janney Montgomery Scott and Ridgewood Capital Funding. Mr. Molinari is an active speaker on issues related to capital markets and early-stage companies and has been invited to testify before the House of Representatives Committee on Financial Services, Subcommittee on Capital Markets, and government-sponsored enterprises. Once again, our panel members bring a variety of viewpoints, drawing collectively on experience at the highest level of the industry's regulatory bodies and prominent policy institutes. Paul Atkins served as Commissioner of the Securities Exchange Commission from 2002 to 2008. Prior to his appointment to the SEC, he was a partner at PricewaterhouseCoopers, where he worked on regulatory compliance, internal controls, and risk management issues for financial services firms. Mr. Atkins is currently chief executive at Potomac Global Partners and is a visiting scholar at the American Enterprise Institute, where he works on issues related to U.S. and international regulation of the financial services industry. Robert Colby is a chief legal officer at the Financial Industry Regulatory Authority, or FINRA, where he oversees FINRA's corporate and regulatory general counsel functions, as well as FINRA's regulatory policy group and the Office of Emerging Regulatory Issues. Mr. Colby spent 17 years as Deputy Director of the SEC's Division of Trading and Markets, and 11 years more as Chief Counsel of the Division and Chief of the Division's Branch of Market Structure. He also spent several years in private practice focusing on regulatory and compliance matters involving securities and derivatives for financial institutions, markets, and clearing organizations. Daniel Gorfine is Director of Financial Markets Policy and Legal Counsel in the Washington office of the Milken Institute. He focuses on entrepreneurship, capital access, and financial market issues. Before joining the Institute, Mr. Gorfine served as counsel to a wide range of business and nonprofit clients on commercial litigation and arbitration, regulatory, antitrust, and international matters. And Anthony Randazzo is Director of Economic Research for Reason Foundation. He specializes in housing finance, financial services regulation, and macroeconomic policy. Mr. Randazzo's work has been featured in the Wall Street Journal, Forbes, Barron's, the Washington Times, the Detroit News, Chicago Sun-Times, Reason Magazine, and various other online and print publications. So with that, Vince, would you like to get us started?
Absolutely. Can't wait after that ending. Well, Sarah, Brian, everybody at CrowdCheck, thank you for organizing such an awesome day today, and the esteemed panelists we have. I'm really honored to be up here, and I'm not sure I'm quite deserving to be here with all of you, but thank everybody for a little closer now. Can you guys hear that okay? There we go. We're on. How's that? Any good? Any better? Any better? Well, that worked. Hello? There we go. Hey. I think it's really essential for days like this to continue with, oh, let me try this, sorry. Thanks. Take 3. Great. Take 4. Well, again, Sarah and Brian, everybody at CrowdCheck, thank you for organizing this great day and the amazing panelists that we have. And I think it's really incumbent on all of us to participate and continue the awareness and education and really the debate. And the great part about what we were expecting, I think, from CrowdCheck is that we'd have a great mix of participants that don't all agree. And I think that's essential to coming out with some of the best outcomes so we hear each other's view and arrive at the best possible outcome. I think it's important to point out that part of the frustration I think that a lot of us are experiencing is really the unique time that we're in when we start to look at perhaps 70 or 80 years of securities law that is now being somewhat amended when we look at the securities world and the app world crossing over. Two very distinctly different aspects, and I think part of the earlier panel talking about, yeah, crowdfunding's been around for a while and donation-based and reward-based, but when we cross over that line of the securities world, it's a dramatically different instrument, and I think needs to be understood, and I think certainly Bob and all the folks at FINRA and our friends at the SEC and NASAA have been incredibly engaging in the process and trying to come out with the best rules possible, but it is a real challenge, and hopefully through these processes, everybody's voice is heard, and again, we do come out with the best outcome possible to get back to what this was all about in capital formation that leads to job creation, economic recovery, and dare we say eventually economic expansion. So kind of the best thought we had here was to start a little bit differently perhaps and have everybody on the panel just give a 5-minute briefing presentation of their viewpoint overall, and then we can jump into some questions. So maybe we'll start, Paul, down at that end, if it's okay with you. Hopefully you've better luck with the mic.
Yeah. Is that working? Is that working? Can you hear me? Okay, all right, great. Well, first of all, I think, I think this is a good experiment by Congress to go down this road. And when you look at the various aspects of Jobs Act, obviously the SEC has a lot on its plate, but I just think that in this particular instance with crowdfunding, like with Dodd-Frank, the SEC asked for a lot of it, and in fact, on this part, I think, especially when you look at the legislative history, had probably a large hand in writing this part of the bill, including giving itself 270 days to do the rulemaking. So I think it's a little disingenuous to complain about it. And secondly, and also in this particular part of the act, the Senate version, which is the one that prevailed, was the one that gave the SEC a lot of leeway with keeping offering caps low. And when you look at the difficulty to get economies of scale here, with the largest offering being $1 million, that puts a lot of pressure on the economics of it. But so all that being said, there are protections in this. So in that aspect, I think this part of the act should not be that controversial. We have to look at the overall vote of this, and really only Jim Webb was the no vote on, if you add up all the things on the amendment and then the final passage. And then with respect to folks who are saying that this is a recipe for fraud, I don't really subscribe to that. I think the bill has significant investor protections to it. And in fact, when you look at people in the House who praised the bill, Carolyn Maloney was commending her colleagues on the other side of the aisle for their work on the issue. Maxine Waters also agreed and complimented the chairman of the committee for it. And even Barney Frank stated that, quote, "I would just urge all members to tell people about this cooperation on both sides of the aisle, because given the harmonious nature of it, nothing will appear in the media about it." So, when we look for how the securities are restricted for a year, that the SEC has broad rulemaking authority in this area, and that there are so many protections and obligations for intermediaries, I think that's a lot of protection there. And then with respect to the burdensome nature of it, I think there's a real risk that if the rules come out to be too burdensome, that companies just won't do it. I understand Mercer Bullard in the previous panel talked about this a little bit, because I think we should try to avoid a situation where, because of the burdens imposed by regulation, only desperate companies are the ones that wind up using this type of facility to raise money. And especially with a cap of $1 million, it's hard to make the economies of scale work. And so I think there's a risk that the SEC can create these sorts of barriers to entry so that this provision becomes a dead letter. And that would have the perverse effect then of, and I believe this is what Mercer was talking about, if that 506 then becomes the real preferred way of doing it, it will basically strangle this baby before it gets going. there's Section 12 liability, which is pretty important. And if you look at 506, of course, there's no Section 11 or Section 12 liability at all. And I think what's important to remember is that we cannot say that every investor losses due to fraud. There are bad investments, and there's no guarantees at all in life. And on the other hand, if you look at historically, angel investing and other things, hedge funds and whatnot, the problem is that average investors have been frozen out of investment opportunities. And so, and when you look at some of the things that are growing up now with respect to market demand, like CrowdCheck, it shows that there is a demand to provide more information and protection out there from the private side. And one thing that I like to, just in closing here, one thing I like to remind people about is when you look at the historic state-based regulatory system of merit-based regulation, and you look at the federal system of disclosure, I think you can see how the general performance over the years has been much more, the federal system has been really the pacemaker here. And what I like to point out is Apple Computer, which went public just before I became a lawyer. This is back in 1980. And the SEC approved the registration statement of Apple, but the offering was still subject to merit review in the various states. And so Massachusetts decided that it would prohibit the offering of Apple shares because they were too risky. So the joke was back then that, like a lot of explicit adult movies, Apple was banned in Boston. Texas approved the sale, but after an extensive review, but put so many restrictions on it that Apple wound up not going there, and it didn't even bother to register in Illinois. And so, again, if here you had various state bureaucrats imposing restrictions and costs and obligations so that some of their citizens were frozen out of what became one of the most successful companies of all time. So I think that's the real balance that we have to remember that we have to weigh here. Thank you.
Great. Thank you. Anthony?
Thank you guys for coming. Is this coming through? Great. Thanks, Sarah, for the invitation to be here. I would say that the most important thing in terms of framing this debate, or really a discussion about crowdfunding, is to make sure that we are keeping separate the difference between unsophisticated investor protection and fraud, which Prashant was talking about. It is vitally important, because if we're talking about unsophisticated investor protection, then the whole nature of the discussion stops. If we're talking about fraud specifically, if we're talking about preventing con artists from coming in and sending forth a whole bunch of false statements, if we're talking about trying to keep people from wasting their money, that is a sense of trying to use the regulatory system to protect as opposed to prevent crime. So if we're going to just talk about fraud, if that's all it's going to be, then I would suggest and put forth for discussion that really, as far as the law is written, the SEC doesn't have to do anything else other than simply implement the details that were outlined, the authorities given to them, because the private sector and the incentives that are going to be in place are going to prevent much of the fraud that does exist, and the fraud that does happen anyway, which there's going to be fraud. There's always going to be a little bit of fraud when you have an open system. As long as the SEC is not pretending to protect investors by saying that we're going to stamp out all fraud, then the risk ultimately still remains with the investors themselves. Some thoughts on how the private sector might go about this in terms of issuer fraud, which I think the first panel talked about a lot, although I was on the train down from New York, so I missed it. We've got great ideas like CrowdCheck that are going to be a potential tool to stamp out issuer fraud. What do we want to do? We want details, we want transparency, we want verification of the details and transparency coming from issuers, and you will have groups that will pop up to provide this, to work on the verification side, and intermediaries themselves are going to have any platform that's issuances are going to come from, they themselves are going to have strong incentives to want to look into who actually is putting forth an issuance through whatever their platform is. They've got reputational risk at hand, and maybe they're using services like CrowdCheck, or maybe they're developing their own systems, but they're going to have a reputational risk that I think if you're an investor and you're in the crowdsource community in the first place, and you know that there's a particular intermediary that has a lot of fraudulent transactions that are going on, you're avoiding that particular platform. And if you're the intermediary itself, you're going to want to boost volume. You're going to want as many transactions coming through as you possibly can. There's a very strong incentive put in place there, and I think that alone is going to stop a lot of, or it's going to track down and stop in its place a lot of potential fraud. Of course, then you've got the potential for fly-by digital night intermediaries popping up. We are talking about the internet. It's always possible for somebody to set up a website. They put together a crowdfunding URL, and you're an investor, you're an unsophisticated investor, and you see there's this great issuance, this great company guaranteed to fail that doesn't really, or guaranteed not to fail, that doesn't exist. That doesn't exist at all because it was just some website that's put forward a fake platform. So if we're depending on intermediaries, then you have that risk. So I would suggest that if I'm an investor, I'm going to want some kind of third-party verification of that kind of a platform, and that can come through an independent regulator. It doesn't have to be the SEC. It could be a group like FINRA that has best practices for how intermediaries are supposed to operate. These brokerage houses, how they and can have groups register with them, go through a series of disclosures, check into what it is this brokerage group really is, make sure that they're a credible organization, and then they get this independent regulatory group stamp of approval, a FINRA approved or something like that. That works in a lot of ways that credit card companies, when you're doing transactions, like Visa signature is an example of a sort of a check that they've put in place to make sure that you're not getting scammed when you use your credit card online. So you have a third-party verification of the actual brokerage group itself. So as an investor, I know that I can go to this group that not only has reputation for the transactions that have gone through their organization, which are going to be well known via social networking. That's what we're talking about in the first place, but they're also going to have this third-party stamp of approval, and that in and of itself is going to be able to stamp out a lot of fraud. Again, there's still going to be unsophisticated investors that are going to succumb to scams. I think that the more the SEC tries to do, the more that there is some sense that the government's there to protect you, and so anything that you see must be have been approved by the government, and so it's okay. The more that notion exists, the more fraud there's going to be. As far as the law stands right now, issuers have a whole host of things that they have to disclose.
I'm sorry if I could just interrupt, just so we can get,
Sure,
I think we can circle back to that. If Dan, you could just jump in with a little background.
Thanks.
Great. Well, first and foremost, I also want to thank our organizers, all of you, for being here. I'm with the Milken Institute. We're a nonprofit, nonpartisan economic policy think tank. And two of our key pillars of our mission are capital access and job creation. I think if the Jobs Act and crowdfunding are implemented properly, I think it could go a long way to having a positive impact in both of those categories. In terms of the view of regulations, I view it as regulation's ultimate goal should be to incentivize crowdfunding transactions that have natural checks in place that can mitigate the risk of fraud. So what do I mean by that? First and foremost, this came up on the first panel. Debt as a model for crowdfunding doesn't get a lot of attention, but I think it should. In fact, I think that the potential scope of debt crowdfunding is far broader than equity. I say that because we have some real-world examples. So in the UK, where securities crowdfunding is currently legal, there is a platform called Funding Circle that in less than 3 years has raised over $140 million through debt crowdfunding. That compares to a total of $10 million for some equity platforms that are in the UK and also in the Netherlands. So what is it about debt? It's that these are companies that already exist that are usually able to sell debt. They have existing cash flows, and we have known risk models where we can assess the creditworthiness of a company. So there are some inherent protections there. Now, what do we need to do from a regulatory perspective is make sure that crowdfunding portals in the US are able to actually post something like a credit score or something that deems the creditworthiness of a company. The problem here is that might run afoul of the investment advice prohibition in the Jobs Act, so we need clarification from the SEC. Can portals actually facilitate that crowdfunding by providing investors with that kind of information? Secondly, if we're talking about equity, I do also think that there's going to be a large role for equity, but like I said, I think overall it's going to be a smaller market than we're going to see with debt. If you're trying to facilitate equity transactions, I would suggest greenlighting or creating a model that exempts from certain of the more onerous regulations from the Jobs Act, the coupling of traditional investors with the crowd. So what I mean by that is if you can find a way to have traditional accredited investors that may be CDFIs, community development finance institutions, certain lenders, come in and provide some kind of early on due diligence where they look at a project, but they say, we want to get verification from the crowd or potential gap financing from the crowd that would fit into a nice capital structure. If you have that kind of a model, you get the best of both worlds. You get the accredited investor providing that due diligence, and then the crowd providing some kind of product or project verification. I'll go quickly so we can get into some more discussion here. Third, with respect to portals themselves, I do think that regulators should empower platforms and portals to experiment with ways to ferret out fraud themselves. I mean, we have the example of eBay. Everybody was concerned once upon a time that there was going to be rampant fraud on eBay. But through the use of certain algorithms, eBay has done a very nice job of being able to ferret out that fraud. I would like to see the portals get to experiment with that themselves. I mean, Indiegogo is one of the big non-financial return models or platforms out there, and they've stated that there's been zero fraud on their portal, in part because they've been able to run their algorithms to try to sniff out and detect fraud. So I want to make sure that there's enough leeway for portals to do that and also communicate that information to investors, again, without it running afoul of the investment advice prohibition. Finally, I would also suggest empowering the crowd. I mean, one of the phenomenons that we've seen with non-financial return crowdfunding is on sites like Kickstarter and Indiegogo, if a project lead or an entrepreneur posts a project, starts raising money, and then goes dark or stops communicating with the crowd will barrage that individual through social media and through the portal itself. And that's a very powerful feature. So currently in the Jobs Act, the law is set up where if you don't meet your capital raise requirement, the transaction doesn't take place. I would suggest maybe we create like a minimum raise and then allow a company to raise more than that so that you enable the crowd to comment on how things are going. I would like that feedback to be transmitted out to other potential investors who can then hopefully make sound decisions based on what they're hearing back from that additional filter. So those are some simple steps that I think deal with the different models and also empower the crowd as well as portals.
Thanks, Dan. Bob?
Well, thank you. I wanted to say a few words about FINRA since it's not exactly a household name in crowdfunding circles. FINRA is a private securities regulator. It's funded by the broker-dealer side of the industry. It's informed by the industry, but it's not controlled by the industry. It has a majority independent board, and it actually acts independently. It writes rules for broker-dealers, examines them, and forces the rules. It's really sort of, with the states, if you will, we're the ground level examination of the broker-dealer community. Alongside the SEC, they tend to take more of the big fraud cases, and we do the routine abuse that goes on out among the 600,000 salespeople in the broker-dealer world. We're in this space because Congress chose to require funding portals to become a member of a self-regulatory organization, and at the moment we're the only one that has volunteered to do that. So most of the, probably all the funding portals are looking to us in order to become members, in order to get their business going under the Title III. So our role is not to tell crowdfunding portals how to do their business, but simply we're required to go through our rules and re-examine which of them should apply to the particular type of business that funding portals do, and then to supervise and enforce compliance with those rules. So you'll look to the SEC rules largely to shape the conditions under which funding portals will operate. Our rules are going to be a much more narrow set of rules that govern sort of base level conduct. So we have put out a request for comment about what our rules should look like. We put out a voluntary form if people wanted to get going with us and start a dialogue. They can do that. We've had 23 funding portals submit those voluntary applications. We're working on our rules. We have a very dense rule book that applies to broker-dealers. We also have a very dense set of broker-dealers.
Not to be misinterpreted.
Yes, that's right. I would say, though, just to be clear, we do not approve members. In fact, there's some that we generally disapprove of, but they continue our members. So we don't give a stamp of approval that says this is someone that it's safe to deal with. What we do have is a website where you can go and look at what sort of regulatory actions have been taken by the states or by the SEC or by us and make a judgment about the integrity of that broker-dealer or that salesperson, that financial advisor that you may be dealing with. And that's, if you're dealing with a securities firm, it's definitely worth looking at that. So we're going through our rule book. At this point, we're going to come out with our rules after the SEC comes out with theirs. So ours can only be secondary to theirs. Once we know what they're going to propose, we'll propose ours. We'll adopt them after the SEC adopts theirs. Ideally, it will be very shortly after, so we don't want to be an impediment as part of this process. Our rules are, at this stage, what we're thinking of, we're going to cover some base requirements that broker-dealers live with. You're going to have to comply with just and equitable principles of trade. You're not allowed to manipulate. The firms will have to become members, and there'll be a very shortened membership process. Part of what we do in the membership process is discretionary, frankly. If we look and see a firm that we think, because of their long history of abuse, can't operate in the business, then we will not allow them to be a member. They can then appeal that from us all the way up to the circuit courts, and we're going to apply that process here. Statutory disqualifications, if people have been banned from business in Kansas or they've been held liable for gross fraud, they're not allowed to be in the business. We hope those people won't then turn to running funding portals. If they do, they're not going to make it through the membership process with us. And then they're going to be, we're going to apply our examination enforcement powers to funding portals so we can do our job of looking at how they're operating to see that they're compliance with the rules.
Thanks, Bob. And obviously quite a bit there to jump into, but just a couple of points. Talk about the stamp, if you would. Obviously, FINRA, as Bob said, doesn't do that, but as the industry itself, there's two organizations, the Crowdfunding Professional Association, which can be joined, and there is a badge associated with that. I co-chair something called the Crowdfunding Intermediary Regulatory Advocates, which is an advocacy group focused on working with the regulatory bodies during the rulemaking period, and there's also a badge associated with being involved in that organization. And those are really for the crowdfunding portals and the broker-dealers that are adhering and had agreed to the best practices that have been put forth by the industry group, as well as a lot of the standardization looking to bring forward in the industry. So that's kind of the beginnings of the private sector, the market participants, trying to put forth best practices to operate from. And I think just as part of the takeaways from the opening, I think the theme that we're hearing over and over again, and perhaps overlaying into the first panel, is fraud versus failure. And I think that's a very important issue that we can delve further into. And really the curation period, and again, something that's not permitted for crowdfunding portals under Title III, because it effectively, as Dan pointed out, runs into the investment advisory issues. But I think we have to be also conscious that we don't end up with adverse selection, and I've forgotten who spoke earlier about that, and ending up with a lot of less than desirable opportunities on the portals. And I think it was Mercer and Joan that touched on the differences really in Title II and Title III, and kind of commingling Title II into crowdfunding, which it's kind of not necessarily crowdfunding per se as we're thinking about it in Title III, when you're really thinking of the accrediteds and some of the ability. So just got a bit of framing as we begin the conversation. But I think the first question I'll throw out, and maybe this is for Bob, do you think it's possible to design a regulatory system that focuses
all sorts of things at the NASD and at the SEC and everything else. So, and he in fact used that patina of respectability, having, being part of the regulatory system in a particular way, and also being SEC registered. So, we discussed that before, but I think the danger is doing too much, and that kills the product as well.
Actually, I just kind of following off of that and coming back to the initial point about pushing things from Title III to Title II, I mean, my observations there would be that there's no question if we make it so onerous on portals through Title III that many of them will feel obligated to register as a broker-dealer and maybe shift over to Title II and deal with accrediteds in Title II. If the regulations are balanced, though, and we don't do that, I think you're going to see industry sort out a little bit and filter between those two different options. So in the case of small local businesses, and again, I'm going to go back to debt, if you've got an existing coffee shop or a pastry shop that's looking to raise capital, they may want to use Title III precisely because it does engage average citizens. I mean, it's the crowd, and you're trying to build a client base, and you're going to attract local interest. So I think you're going to see a lot of local endeavors, local projects that are going to seek Title III public crowdfunding. It could be debt. I mean, it could also be equity. With Title II, when you move into the accredited space, I would say that you're more likely to see high-tech, kind of high-growth companies going that direction because they're going to probably want to raise more money than the $1 million cap that exists for Title III. I would also point out that there is this weird system in place right now where Title III has a lot of regulations that are baked into the law itself and a lot of investor protections. And then as someone noted earlier today, when you move over to Title II, there are very, very few investor protections. And that's because we assume or presume under the securities laws that accredited investors are sophisticated enough to protect themselves. I would say that the current estimates I've seen is that only 3% of all accredited investors out there are currently participating in private markets, meaning that 97% are not. So when you start blasting out general solicitation or advertisement for private offerings, I think you are going to get a lot of new investors entering the marketplace. And I would be a proponent of having some very basic baseline disclosure requirements with Title II so that you're creating a slightly more even playing field and also adequately protecting investors there. So there is a weird, or not, I wouldn't say weird, but there is an interplay that goes on, I think, between Title II and Title III.
Anthony, you want to?
Well, and just to reiterate on that, the other thing that we want to avoid, if the rules that come down for Title III are too strict, is that you're going to wind up with only the least sophisticated and high-risk offerings that fall into Title III, which in effect is going to move and that's where most of the unsophisticated investors are going to wind up going. So you're going to concentrate risk at the crowd in what we're talking about traditionally, at least we're thinking about in terms of crowdfunding, which would more or less just blow up the entire project.
Are there additional steps that anybody might add that could be taken to reduce the bad behavior of a few that may be present in the industry without over-regulating it? And is there a risk to that?
There's at least a risk on behalf of the SEC. I think looking for third-party approval and badges, I was saying, wherever it comes from, whatever those groups are, it should be incredibly important for whatever the brokerage platform intermediary group is. I think that's a really important step to see how that develops, and to and have that be the case so that these different portals can experiment, as Dan was saying, with how they want to go about doing this, because this is it's not a completely new space, because we have Indiegogo and Kickstarter, and we have some examples of how this stuff works, but it's and there's even some activity in what looks like crowdfunding, but with more accredited investors even right now. So it's not 100% new, but there's still a lot of room to innovate and to grow. And having the SEC try to come down too onerously as opposed to letting third-party verification services in the private sector do it would enable a lot of this entrepreneurial activity at the issuance level.
I think that's a good segue. Maybe, Paul, you want to jump into this one, or Bob. In terms of the private sector and their role in the regulatory system, how appropriate is it you think for the regulators to rely on the private sector to get their own marketplace right?
Well, you kind of have to, because the regulators can't be everywhere. And unfortunately, the way the Enforcement Division of the SEC has done things in the last few years, they're going more for headlines rather than for actual real, looking after mom and pop who gets ripped off, where the former enforcement director said to me that she viewed Ponzi schemes as pre-Madoff, Ponzi schemes, pump and dump schemes, and slip and fall cases that were hardly worth SEC time. So I think that's a problem. But anyway, so I'm hoping the new chairman can address some of these issues inherent in the SEC's enforcement program. But basically, that the government can't be everywhere, and so that's why I think some of the groups like CrowdCheck and the other things envisioned by the folks who drafted the crowdfunding provisions, expect for the marketplace to step in, and like you mentioned before with eBay and whatnot, where there's an incentive for these portals to try to prevent fraud. I think that's a vital aspect of it. And, reputation risk and everything else to the extent that brokers and others are in. We have to realize that, Madoff had, that fake accounting firm basically sign off on his stuff. So there's always a risk, but the answer as between do nothing or, at least where, most of the time things are done, honestly or without fraud, maybe, is the best.
Yeah, and look, I would say this. I would say overall, you're never going to eliminate all fraud. The thing that we're looking at is how much downside risk is there, and how large of a role should regulators play to try to limit that downside risk. Now, I think there's already, with Title III crowdfunding, you do have investor caps. That does limit some of the downside risk. And I would also point out that the overall, to put it in perspective, the overall size of the crowdfunding industry, there are some estimates saying in the next year or two you could see it become a $6 billion industry. If it even eventually gets as successful as venture capital, that would be, a couple years ago, venture capital invested $22 billion total in a year. That was in 2010. So just as a thought experiment, if you were able to match that with crowdfunding, $22 billion, and let's assume that every single crowdfunding venture fails or there's fraud with every project, that's a third of the amount of money that was lost at Enron in terms of total shareholder value lost. It was $60 billion with Enron. And I don't say that to minimize the risk of fraud here, but we have to think about it in proportion. Downside risk also with the balance of how onerous are the regulations going to be. And it's a hard balance to strike, but I think it's important to keep that in context.
Anything to add on that?
Well, look, I'd say, let me be clear, no amount of fraud is acceptable.
You're anticipating my next question.
That's what I have to say. But
You're lucky. Wait, I'm going to turn that over.
All right. I'll wait for your question.
It's okay.
Well, let me just, but no amount of armed assault is acceptable either. But it doesn't mean that every measure to deal with it is a good one, right? So we all know that it's males under 40 that assault people after dark, and so, the best way to prevent it is to not allow males out under 40 to go out after dark, which would mean there'd be lots of seats at the bar for baby boomers, right? But it still doesn't mean it's a good measure. So.
I guess that leads to the question, is it possible to design a system that has zero fraud for crowdfunding?
Sure.
Wow. Can I give you this right back?
You prevent it. You don't allow it at all.
Well, and how would we prevent it without strangling the benefit or the capital flow in those instances? When is too much regulation going to prevent the benefit, where people will just say, this just isn't a economic or realistic mechanism to raise money anymore, and go to Title II or go to some other mechanism.
Right, well, I've answered my share questions.
Well, to that point, I agree with Bob. It's easy to talk about fraud, but what I, always liked to focus on is that even in these so-called slip and fall cases where, the SEC enforcement folks would cast aspersions on smaller frauds, that can wreak devastating havoc for real people who have put real money into something. So you can't forget that. But on the other hand, I don't think we can design a system that is fraud-proof, because even if we got rid of this whole thing about crowdfunding and went to a German-based system where you have to go to a bank and you have a credit officer that before you can even access any money from outside your family or whatever, that you have to go through all these different things, there's still fraud, and the history's replete with banks who've gotten snookered and everything else. So even cognoscenti and folks who are very sophisticated get taken. And so given all that, I think that, again, you have to have a balance, and you have to remember that, the objective of the act was that we have problems in the banking industry, and we saw it at the Congressional Oversight Panel for TARP when I was sitting on it, that there were problems with banks and the financial crisis lending money. And so the answer is going to the capital markets where there might be more, more of a free flow. And so there are a lot of protections in here as to maximum investment by people, and even with the liar loans and everything else with mortgages. You have other folks who want so badly to get into something they don't tell the truth. So it goes for both sides. So I think, we have to have a balance.
Did you have something
Well,
like that?
and I would actually answer the question. If you were to actually not allow securities crowdfunding, you would still have fraud in crowdfunding. And that's because there's the non-financial return regime that exists right now. And as far as I'm aware, that's just regulated under state fraud laws. So people are able to already use the internet for all kinds of projects and ideas and try to raise money. So that is already happening. And again, I say that just to put in context where securities crowdfunding fits in that space. Again, limiting the downside risk, investor caps, I think, makes a lot of sense in terms of the total amount that an investor can invest, and really requiring information disclosures so that people are armed with the information to make good decisions. I think that's really the right way to pursue this.
We're going to open up to the floor for any questions. So if anybody has questions, if we could use that mic in the middle, please. I'm going to hold my seat just to make sure I'm ready.
First, I used to run a center at the Milken Institute, and I was very happy to see that you were starting to do economic reports about crowdfunding, because the fact that only 3% roughly of people who could invest in the crowd economy do means that we are losing a huge amount of investment activity that can create jobs in the inner city, help research, all kinds of things. And now that's going to be able to be done. The question is really about FINRA. Last week, David Blass issued 2 no-action letters to Funders Club and Angel List that basically said, you do not have to be a broker-dealer because you're not going to charge transaction fees, and you can create serial funds in the same year, each one of which is designed to invest in a specific company. So those 2 groups are now going to aggregate investors into serial funds to make one investment and not be broker-dealers. So my group is a broker-dealer. Why do we want to continue to be regulated under FINRA if we can do all of that without being broker-dealers and still get a carrot?
Well, I assume you don't fit within the conditions of those letters, but if you did, I'm sure you'd follow them, right?
What was your reaction to those letters in terms of how does FINRA going to respond to that in terms of should people be allowed to opt out of the broker-dealer rules and do serial funds, which is a new thing that's not been allowed before?
The question of who is a broker-dealer and thus has to be a member of FINRA is determined by the SEC, and so we will follow right down the line on those letters.
I'm sorry, I think maybe just on the differentiation there on those particularly, the carried interest, right? So they're not collecting a transaction fee, which would put them squarely into FINRA regulations as the broker-dealer. So I think in the absence of doing that is where they have the ability to take the carried interest versus the transaction fee.
Right, the one is taking the 10% administrative fee. The other one's not. So,
Thank you.
Crowdfund Insider, and just for some perspective, we covered the crowdfunding industry, and one of the things that I've found in covering rewards in the donation world is instances of fraud tend to be exasperated by the crowd. What I mean by that is if the crowd sees something that looks potentially fraudulent, I've seen instances where the crowd runs with it and tends to create a little more fraud than is probably there, if that makes sense. Can you translate that to the security world? I realize I'm talking a bit hypothetically here, but if the crowd were to grab onto things that resemble fraud or even just being disingenuous, you're talking about a livelihood at stake versus like a product or something like that in the rewards world. Is that more legally contentious in the security sense?
So just to clarify, are you saying that you're seeing more instances, though, of the crowd advancing a fraudulent project, kind of through a herd mentality?
Where there's minimal instance of, and it might not even be fraud, it might just be something that's disingenuous, like, for example, there was a campaign where a woman, she was seeking $1,000 in contributions, and she had a pretty well-paying job. The crowd found out about that and started digging and surfaced all of these things and presented them as, as this woman is being extremely fraudulent. A lot of them weren't true. A lot of them were flat lies. In the rewards world, that's, everybody just kind of wipes their hands and walks away. But in a security sense, you're talking about somebody's livelihood. So can you translate that effect? Like, let's assume that does happen in investment crowdfunding. What is the effect of that?
I'll take a shot at answering that. I mean, I think that, that's going to potentially invoke certain business torts that would exist. I mean, that sounds like defamation to me if they're false statements. But all that being said, I think that's just one of the risks that entrepreneurs need to weigh when they consider raising capital through crowdfunding, through a crowdfunding platform. I don't know that you're necessary. I think that not enough attention is actually focused on that side of this, is the entrepreneur's risk, right? So I certainly see there's going to be space for crowdfunding portals to start to vet investors as well as they're vetting the issuer or the entrepreneur. So I could see something working out there because it's going to be very important who your investors may be.
Maybe just follow up, so that is, there's precedent for that being legally actionable?
Oh, I don't know if I can speak to that. I would imagine just under, as that sounds like defamation or some kind of a business tort, I would imagine, but I don't know if there's others who.
I think what you're looking at is we're in an entirely new industry that is going to evolve and it's going to iterate. And there's some things that we anticipate probably going to work really, really well and things that we think are going to be completely the opposite. So I think it's I think the reason why a lot of the people in this space are pretty happy to get to some even beta program to figure out how it really works instead of all of our hypotheticals that zero fraud to all this fraud and figure out what it really means.
Yeah, what you're talking about almost sounds a little bit like as we look at Herbalife, where you have two different camps who are arguing, is it fraudulent or not? I have no clue. I don't know. I just know what I read in the paper. But so you have that. You have all sorts of things that go on in the business market where people, argue that there are bear raids and other things that go on. So, usually truth is the best defense, and so that hopefully wins out.
And we are talking about it, the social networking community in the first place. Bullying could happen. You could have a rival business that wants to try and shut down, some kind of debt issuance or whatnot. It's theoretically possible, but you also, Stan said, you got to know what you're getting into, at least on that side. And there definitely needs to be a lot of liability lying with the actual entrepreneur themselves.
Yes, my name is Arnold King. I'm
So, anybody want to take that? I think the question was surrounding the audit requirements on crowdfunding? Yeah. Any crowdfunding campaign that's $500,000 or greater will require an audit. Things below that, different thresholds of CFO sign-offs and attestations, but above $500,000 or greater would be required to have an audit. You want to take that?
Sure. Well, if you're a funding portal, you can't solicit and you can't recommend. So if, like most businesses, you need solicitation or recommendations, then you need to have a broker-dealer involved. Now, you can have a crowdfunding portal and have an affiliate or some other broker that you have a relationship with that does the solicitation and recommendation, but if you want to have that aspect of your business, you can't be a standalone funding portal.
Mr. Elenoff.
One of the big differences that you've seen in the crowdfunding industry as it's developing that you actually think are unique, beneficial, and potentially things that we can raise for jobs and other security programs. It seems the legislation has some innovative provisions, like Dan pointed out, in the past, that maybe the regulators like and doesn't seem like they're
So you're asking what can we learn from kind of Jobs Act legislation that can be applied more broadly? I mean, you know, I would take a very big picture view of this and just say that what I think the Jobs Act is trying to do and what we're looking at with crowdfunding and with Title II is just a realization that information technology, namely being the internet, is having a really profound impact on the way that people access capital and the way that money flows. And I think that the Jobs Act is just beginning to kind of embrace that. It's part of an evolution. We had discount retail brokerages 20 years ago, and that was just making it cheaper and easier to reach out to a broader array of investors. And I think you're starting to see that now with the Jobs Act. And my guess is that recognition that social media, I mean, I think there was just recently the SEC said that you can now issue corporate statements through social media. And that, again, is just taking into account this ongoing evolution.
Great. Thanks. That's our last question. Brian Knight from CrowdCheck is going to come up. The panel is going to stay in place while we go to the next.